So the Peloton CEO, John Foley, drops $55 million on this Hamptons compound, which is it's a pretty nice looking place, right? But let's get right into the story. So Peloton chief executive John Foley has quietly snatched up a 55 million estate in East Hampton, even as employees of the exercise bike company fret about their future as its stock price tanks, the Post has learned. So Foley's new 4-acre spread, which includes 5-bedroom, 7-bath mansion designed by architect Francis Fleetwood that spans 6,100 square feet and straddles 400 feet of private oceanfront, got scooped up on December 2nd, according to a little noticed Instagram post by Catherine Jurasic, a real estate agent at Douglas Elliman. Jurasic didn't identify Foley as the buyer, but sources confirmed to the Post that the fitness tycoon bought the lavish compound above its asking price of $52.5 million dollars. The spread at 442 Further Lane went on the market in September. Eilerman declined to comment when told about the sale. A current Peloton employee told the Post, "I'm disappointed, but somehow I'm not surprised." The employee said that the value of the Peloton stock options has plummeted by 75% in 2021, and investors have soured on the stock as vaccines and loosening COVID-19 restrictions send fitness fanatics back to the gym. And here's the thing, this is the reason why you have to be very careful when investing into individual stocks. This is why typically for the everyday investor it is better to, and again, typically, right, to invest into something more like SPY, into like a S&P 500 or like a Vanguard ETF kind of thing, right? That invest into the S&P 500, right? Because over time, because you're trying to build your wealth, long term, you will typically make a good return on your money. Your money will typically compound and double every 7 to 10 years, right? Typically, right? But, the S&P 500 has a track record, right? Of beating hedge funds and so on and so on. So, you typically will never really get a 75% drop in price in the S&P 500. So with the company's share price tanking, the employees said some staffers are considering leaving the company if they aren't laid off first. People, to be honest with you now, are worried about layoffs, the employees said. Morale is at an all-time low, and meanwhile, Peloton suffered another blow Thursday when it yanked advertisements tied to the Mr. Big character on, and just like that, after the actor Chris Noth was accused of sexual assault by 2 women, according to a report which Noth strongly denied. The character had died after riding a Peloton bike in the Sex and the City reboot, a plotline that sent the company's shares falling sharply. But pandemonium at Peleton isn't stopping Foley from making real estate deals. So just last month, the CEO made headlines when he put another East Hampton retreat up for sale, a 6-bedroom, 6,400 square foot farmhouse at 12 Cola Lane that sits on 2.2 acres, just a short drive away from the new place. His asking price, $4.5 million, dollars, less than a tenth of what he paid for his new beachfront pad. The Post was first to report Foley had listed the more modest home, which he bought in 2016, from investor Billy Macklowe, son of real estate magnate Harry Macklowe. And over the summer, Foley also kept a yacht, complete with a multi-person staff off the upscale 3 Mile Harbor Marina, a source with direct knowledge to the Post. During the summer, he used the yacht to ferry his family back and forth from the city. News of Foley's high living in the Hamptons comes as Peloton shares have slid more than 70% so far this year, and the company shares stock finished 2020 at more than $150 per share and are now trading under $40 per share. Peloton on Thursday did not respond to requests from the Post for comment on behalf of the company or Foley, and some Peloton employees who joined the company in the months before Foley instituted a company-wide hiring freeze in November have strike prices on their stock options that are higher than the company's current share price, an employee told the Post. That means that the employee's stock options are useless because the cost of exercising them is higher than the shares would be worth. People have been working, giving their blood, sweat, and tears, and have nothing to sell, the employee said. Their options are worthless, and he's out buying a $55 million house. Adding insult to injury, most Peloton employees weren't invited to an opulent holiday party that Foley held at New York's luxury Plaza Hotel on December 8th. Just a group of Peloton instructors, not other employees, were invited to the event, and even the company canceled its annual Christmas party amid concerns about its future, according to a Peloton insider. Foley talked about the party on Tuesday in an email to staffers obtained by the Post, telling staffers that it was an event for our vaccinated family and friends to celebrate all New York City has been through over the past 2 years. The company also claimed that the money for the party came out of Foley's pocket. But as staffers continued to seethe, Foley did not address the issue during a company-wide question and answer session on Wednesday, according to a source who attended the meeting. They can control the questions, the source said, so nothing came up about that party whatsoever. So this is basically like a situation where you have a ship that's burning, and the captain is not wanting to go down with the ship. Basically, they're basically like, swimming in their like captain's room with their hoards of treasure, right? So it's pretty crazy when you really think about it. I think this is probably a really stupid decision on his behalf, company wise, right? Because, like, look, you don't want to demoralize your employees, right? Like, if you have employees that are struggling and you go splurge on a $55 million property, that's really not a good look, right? Now it'd be different, right? If the company is doing good, the employees are doing good, they're making good money, and you go buy something super awesome, right? Because that's motivational, right? For a lot of employees. They're like, yeah, the CEO just bought something amazing. The company's doing amazing. We're making so much money this year, right? I'm probably going to get a raise of like, 20, 30%, right? Or I'm going to get a bonus of like 10 grand or something this year. Yeah, everything is looking good for this company. I got high hopes for this company. I'm going to work hard and work my way up and make more money and so on and so on and so on. But when you have literally everything in the company basically going down the sink, going down the drain, like flushing down the toilet, right? Like a giant turd, right? And you're the CEO and you're just like, spending all the money, like these crazy amounts of money, which, by the way, could help keep people their jobs, right? Could help keep people working at a very productive level because they're making good money because you're not splurging, right? You're reinvesting back into the company. That gets into like a really sticky situation, right? Like you don't want to basically cut your company by the ankles, right? Like you don't want to do that. You want the company to still be able to keep moving in a good direction. And if all the employees basically just are going to hate you, it's not a good look. It's not a good thing. By the way, if you want to learn how to get out of debt, go to 40inbox.com.